Hi, everyone. So my name is Francis, and I'm a PhD candidate at New York University. And my research is really focused on Silicon Valley, and particularly on very early stage startups. And I'm looking at how venture capital investors kind of evaluate deals, what the kind of criteria are for making an investment on this sort of investor side. And then on the startup side, I'm looking at things like the lean startup methodology and really the role that kind of social research plays in entrepreneurship. So you could say my elevator pitch is it's really a kind of anthropological, sociological way of thinking, way of looking at the world, thinking about your product, and so on. So I think this is something that it's really productive to try and translate and apply into the blockchain kind of ICO space. Obviously, the Silicon Valley investors have decades of experience now at choosing promising early stage firms, at least in some cases. And there's a kind of well-established set of rules, kind of heuristics that they're using to choose firms. And again, on the other side, especially in, let's say, the past decade, there's really been a kind of consolidation of the way that an early stage firm finds its market, develops a product, looks for, you probably heard the expression, product market fit. And that's going to be something which we're going to be coming back to quite a lot today. Really, the idea that what makes you successful is not entirely, or certainly not solely, a kind of technological innovation, that you're looking for an insight into a market, that you're trying to find your customers' pain points, is again a really sort of overused phrase. But the idea that to be successful, your product has got to address a need in the market. Now, again, one of the things we're really going to be focusing on today is asking, when you're evaluating a potential blockchain investment, how do you tell whether this is a team that's going to do that effectively? Because once again, this is something that venture capitalists are very, very highly focused on evaluating. So at the first seed stage pitch meeting, that's really going to be the key thing that they're going to be looking for. They're going to be asking, are these founders who understand their market, who can reach out to their customers and really get a sense of what they're looking for from their product? So there's a kind of very widely repeated quote, which comes from Steve Blank, who's really the father of the sort of lean startup movement. And he defines a startup as a temporary organization which is searching for a scalable and repeatable business model. Now, it's really important that kind of focus on the fact that this is a temporary organization, in the sense that when a startup forms, we have a team of people who are coming together really to solve a problem which they have a limited understanding of. So everything is up for iteration, improvement, pivoting. The idea is not that you have a product concept that you're going to take to market. It's that you've identified a market and you're going to identify the product which best fits that market. And in that early stage, as that kind of temporary organization, you don't have a set business plan. You don't necessarily even have a revenue model. You're exploring that problem space. And really, this is something that in the kind of blockchain space, as we're going to see, this isn't necessarily something which fits all the kind of early stage firms that we're seeing, in the sense that there seems to be a more kind of solidified idea of the product use case earlier on, than maybe we would expect in kind of non-blockchain firms. We're going to come back to that. So what a venture capitalist is really looking for is a team that can navigate that early stage kind of solution problem space until they can find, as we say, that product market fit. Now we're going to take a look at how this can be applied to ICOs. And the title of this talk today, so the ICO Risk Bundle, this actually comes from a presentation, from a blog post by Leo Polovets, who's a well-known venture capitalist at Sousa Ventures. And he's kind of a well-known ICO skeptic. Now, I think some of his skepticism is kind of well-deserved. There are other senses in which I think we can really take his concept of the startup as being this bundle of risks from an investor's perspective and actually apply it kind of productively to evaluating a token offering. So essentially what we're going to do is go through a number of broad categories of risk, which are going to be around the product, around the team, and around kind of financing and bigger sort of geopolitical scale risks. And some of these are going to be very familiar to people who are evaluating sort of software as a service, enterprise, startups in general. And I think some of them are sort of much more unique to the blockchain space. So this idea of finding product market fit and of finding a product which users essentially are prepared to pay for because they think that it is going to make their lives, make their jobs easier. So before really starting to even build a product, the lean startup methodology emphasizes going out, getting outside the building and talking to customers. And customers, the people who are going to be paying for your product, may not necessarily be the same people as for people who are going to be the end users of your product. And this is obviously something which needs to be recognized again at that earliest stage. Now, the way startups are advised to do this is essentially ethnographic. It's going out, it's interviewing people, it's doing what's called customer development, which really means sitting down with your customers, in some cases watching them doing their jobs, even doing their jobs yourself to get that kind of first-hand experience. And based on that, refining an initial product, kind of high-end, sort of high concept outline, building out kind of a feature set from that, identifying what features are actually going to be addressing those user pain points. This is absolutely the first stage before kind of prototyping, before really writing any code. And as part of this, startup's going to identify their value proposition, which really is that kind of one line, what we are going to do for our users. And I think in many cases, if you're considering an investment and you can't see a clear articulation of what that value proposition is, you couldn't, say, explain that to somebody in an elevator yourself. That's something which maybe should be a bit of a red flag. Is, do this team really have a strong handle on what their unique value proposition is? And if that's in question, the risk here is, can this team identify those user pain points? Are they getting outside the building? Are they really in touch with their end users? Have they done this kind of customer development work before developing their product, before perhaps even producing their white paper? If they're a payment service, have they gone out and talked to kind of end user retailers, to online sellers? Have they identified if this is a product which is actually going to solve a real world problem? Because obviously if they don't, then it's going to be really difficult, impossible in most cases, to actually get really widespread adoption there. I think it's important to note that a lot of the crypto community, it can be a little inward looking, and it's very easy to find kind of true believers, people who are really already on board with the whole kind of blockchain hype in one sense. These people are always going to be enthusiastic about a new blockchain product, and these kind of hackers who, okay, yeah, maybe they're people who are in engineering positions, they're going to be people who are looking at a product, say, as an alternative to a mainline hosted database service. They're going to be looking at that in a very different way from the kind of enterprise decision makers, the people who, let's say, Amazon Web Services salespeople, they're going to be talking to on a regular basis. They're going to have a completely different set of priorities from these kind of very pro blockchain hackers who, once again, in some cases, yeah, they may have some input on engineering decisions. Are they really going to be the end decision makers? That's another question. So the lean startup methodology emphasizes minimum viable products as kind of an essential tool to identify whether you are really solving a user's need. Now, whether it's possible to build essentially a minimum viable product in a blockchain space, which is what's termed high fidelity enough to really get learning from your users, I think that's a question which the blockchain community should sort of think about in more detail than I've seen yet. So the idea that if you're building a web app, you can really build something which is 2 or 3 days coding maybe, and it's actually capable of delivering a basic service to users. And you can use this really to gain whether users are going to engage with it. So there's going to be a small population of people who are like, my God, this is the perfect tool. This is solving a problem that I've had for years. I don't care that it looks a little crappy, that it's obviously kind of not finished. I'm going to adopt this. And then you can move on to kind of polishing the UI and so forth down the road. This is something which is really difficult to achieve when essentially your value proposition depends on this kind of highly sophisticated engineering proposition. So let's say you're proposing a sort of blockchain product which significantly reduces transaction time. Now, how do you actually demonstrate this works without building the whole product? And I think in many cases, this is something which is not possible. That there does need to be some kind of rethinking of what it means to prototype, to build an MVP in the blockchain space. So whether we can necessarily say, okay, these guys aren't working in the same way that you would be if you were building a web app, consumer mobile app, that may not be quite the most appropriate way of judging the team's kind of customer development skills. On the other hand, there does need to be some kind of sense, I think, that you're looking at a team that is capable of building this knowledge about customer needs without this kind of unmanageable technical overhead. So moving on a little bit to the kind of product quality risks. So Paul Graham, who's the leader of Y Combinator Incubator, which is maybe the best known startup incubator here in San Francisco, he tweeted recently that you can fool investors, but not customers. I think that's something which maybe should be on the wall of some blockchain startups' offices, to be honest. I think this is a really big issue in this space, that we have tokens essentially being valued by investors without this kind of connection to customer perception, to customer feedback on the product, which in the best case, certainly in an incubator like Y Combinator, really with good early stage investors in general, your investors are going to have, whether it's direct contact with customers or whether they're going to be asking to see kind of detailed customer response data, there's going to be that feedback loop. And really with the token model, you don't have that. So only a very small share of blockchain investors are going to be doing that kind of due diligence. So I think the question here would be, do we have a risk that the product quality is not really observable to investors? And in that case, in that sense, the price is kind of unmoored from the product quality in a way that's different from the kind of conventional startup funding model. So to expand on that, we have this sense, generally speaking, that if a product is failing in the market, that it's going to be really difficult to raise kind of successive rounds of venture capital funding. That's really common sense. This does not, at this point, seem to be something which the ICO model is managing well. So there's a term which is the financial guillotine in kind of venture capital studies. And the financial guillotine is essentially what it sounds like. It's having your funding cut off because you're failing. And that means that if you're kind of failing to meet milestones, if you're not reaching the kinds of growth revenue targets that investors expect to see, you're not going to be able to raise a successive round of funding. And if obviously you've raised that funding upfront in an ICO, that risk, that, I mean, from the founder's perspective, that risk, from the investor's perspective, that option to cut off that supply of capital, that's not there. Now, whether this is something which is really raising product quality risk, I think this hasn't played out yet. I think my intuition, and that of most of the venture capitalists who are, let's say, blockchain skeptics at this point, is that no, this is going to turn out to be a fairly significant issue. That we're going to have ongoing issues of governance, that the lack of a kind of investor board, in the sense that a conventional startup has a board that in the last instance can fire the CEO, that this is missing, that we're going to have essentially that this space needs to develop some kind of signaling mechanism whereby product quality is significantly more observable to kind of non-specialist investors. I think this is maybe one of the biggest problems in the space. So when we have kind of highly technical risks, and we've seen this, IOTA has been one kind of high profile instance of this, where we have blockchain-based firms who have products which bear these kind of super technical risks around kind of hacks, that things like attacks on the blockchain with given numbers of bad actors, that these are kind of incredibly hard for anybody who is really not a cryptographer to understand. Now, how effectively are these kinds of risks being priced into token value? I would say really not very effectively at all. That we have these kind of wild price swings based on rumors that are essentially not understood by 99% of the investors. Now, from an investor point of view, this is kind of where we have to diverge, I think, a little from conventional venture capital investing, where there's a kind of non-liquidity of early stage firms. It kind of damps the effect of these kinds of technical issues, technical risks, both in the sense that the valuation is being set by sophisticated investors, in most cases with a team of analysts behind them, versus people who are really trading off Twitter rumors and so on. Now, I don't think there's a kind of straightforward solution to this. But yeah, from an investor point of view, does this mean that while we have a product which has this kind of a larger risk space, that let's say they're using cryptography which is less well understood, should this be kind of priced in both, as it were, as something which is possibly going to affect the kind of absolute value, the kind of usefulness of the product, because it might be found to be kind of fatally flawed? Yes. Is it something which should also kind of be priced in as something which is going to increase volatility, just because we should expect that there are going to be these kinds of rumors? Quite possibly. And again, I don't think there's a sort of straightforward algorithmic sort of way of taking this into account, let's say. But yeah, I think where we have these more and less technologically kind of speculative approaches to the blockchain, definitely that should be influencing price. Again, coming back to this kind of question of investor sophistication, how many people are actually able to understand what's going on here? Very, very few. So I think one thing that's really needed here is more kind of widely accepted audits, kind of analysis reports, which are really digging deeply into that kind of technical risk, but presenting it in a way which is readable to investors who don't have an engineering background. So moving on from this kind of technical side to sales and marketing risk, the average kind of cryptographer who should in fact be building a blockchain project may not be the person who understands the kind of enterprise sales function. And whereas in a conventional startup where we have this kind of well understood business revenue structure, the expectation is, of course, that you're going to hire a VP of sales, that you're going to hire a sales team, that how you're going to sell this product into the enterprise market is well understood. Now, where you have not only a product which is significantly technically different, but also a company which is not kind of dependent on that revenue run rate and so on, I think this is a very kind of high risk area. So how a blockchain firm is going to structure what is essentially this sales function is a big question, and I think in many cases this hasn't been explored really in any way adequately. So where we have a firm which has sort of done an ICO, they have really all their sort of funding has come up front. On firstly, what incentive do they necessarily have beyond obviously hopefully raising the value of the token? What incentive do they have to engage in enterprise sales? And I think this is something that really has to be evaluated on a firm by firm basis. And there are such a multiplicity of kind of different structures, incentives, and so on. You can't really say there's going to be a sort of one size fits all way of evaluating whether this is going to be done right or not. So there may be firms where they're focused on payments and they recognize that selling this service into banks is going to be really crucial to whether this is going to be a successful product. There may be others who take a completely different attitude and really are focusing on, let's say, the stability of the token's price, and are really just essentially taking an if we build it, they will come attitude. Now, this is obviously something that is going to have a huge impact on the ultimate adoption of the token. And I think it's really something which is not covered enough in most white papers. So building on from that, what are the organization's key performance indicators, their metrics? If there's a customer acquisition cost, who's meeting that essentially? Is this something where there's going to be a kind of runway question where the ICO funds are being used to meet sales expenses and there's kind of a limit, and if they haven't gotten to a certain level of adoption before they've run out of money, the token is essentially probably going to go to zero? It's a far bigger question, I think, than is usually examined. So moving on from that a little, this question of how we should look at kind of governance and questions like founder conflict and kind of team cohesion, especially when we're looking at a lot of kind of globally distributed teams, a lot more than in conventional startups. So is this a kind of founding team that look like they have the ability to hold together a company as it scales? Do they have the kind of mentor relationships, which again, in a conventional kind of venture funding situation, would be provided by the investors and the investors' contacts? If there's conflict between the founders, which happens in a lot of startups, how is this going to be handled? So again, kind of with the sort of board and governance questions, we see a lot of token companies that they're looking at the kind of foundation model, and in some cases there's sort of pushes for distributed governance, which again, it's a highly kind of divergent model. As far as I know, no major kind of enterprise startups that have not only their shareholders but their users able to kind of intervene in board level decisions. So to a kind of conventional investor, this is probably something which would really look like a risk that we should be questioning what the effect of having distributed governance protocol, which is really opening up kind of strategic decisions to a user base whose say values, but kind of whose objectives may not be aligned with those of the founders. So in a kind of extreme case, they may be pushing to fork a token when this is against the wishes of the founders, against probably potentially the interests of at least some investors. So how that kind of thing is going to be handled is, again, a sort of big problem that I think has not necessarily been factored into token valuation. So finally, I think looking at the kinds of risks that are really more unique to the token space. And these are essentially ones that have this kind of geopolitical level. Now, there's an extensive body of research that it's really showing that there's a huge kind of regional advantage, to take the title of one book, coming to Silicon Valley firms, coming to firms in kind of the Boston area, places like essentially the global tech hubs. And there's a huge kind of disproportionate chance the companies which are based in these very small areas are going to be successful. And looking at the ICO space, obviously we can instantly see that this is not something which is kind of geographically biased towards Silicon Valley in anything like the same way. So we have a huge number of firms that are based in Russia, Eastern Europe, Asia, relatively few in some ways in the United States and the European Union. Obviously we have some kind of very high profile firms that are, in another sense, I think the kind of regulatory landscape in those normally core markets is in a way driving some firms out of those well understood jurisdictions. And that's obviously something that has the potential to kind of pretty significantly increase risk. So when we're talking about an investment product like conventional sort of startup shares, the regulatory landscape, the legal landscape there is obviously very well understood by investors. So essentially what kind of recourse an investor will have legally, that's the kind of thing that when you're comparing an investment in a startup in Silicon Valley with a token based in, say, Russia or Singapore, it's actually huge difference in how that risk can actually be calculated, simply because there are so many more unpredictable values in most token offerings. Now, that can include the risk that there's going to be a kind of broad clampdown on cryptocurrencies, which, let's say, outside of well understood jurisdictions, that could have a much bigger effect on investors. So it might be a kind of total loss scenario where a token is simply banned. And I think there are people who would kind of have an idealistic understanding of that you couldn't ban a distributed token. In practice, where you have a corporation, foundation, whatever, that is based in a specific jurisdiction, I think the level of disruption there, it's going to have the same effect that an outright ban would have. So yeah, there may be jurisdictions in which we have to factor in that possibility that this product is simply going to get shut down. And once again, that's something which is pretty rare in conventional early stage investing. Now, whether it's going to play out that essentially the same kinds of, so you could say, biases that kind of lead investors to only, in most cases, invest in firms that have that kind of Silicon Valley or kind of tech cluster base. Whether that's going to sort of spread into the ICO space, I think that's something which I think we're going to see kind of clearer answers maybe over the next year or two. My inclination is to think that yes, we probably will. That in fact, there's going to be kind of a convergence between the criteria which established investors are using to judge startups in other spaces. I think that is essentially going to merge to some extent with certainly how institutional investors are looking at tokens. So to answer Ryan's question there, yeah, I think that's right. I think the kind of limited partners who are looking at sort of significant tech investors, most of that money is around Silicon Valley. And I think there are definitely institutional funds kind of in New York and so on that are kind of trying to get into this. I would be interested to see sort of whether those funds were also investing in kind of non-blockchain startups, if you know what I mean. So I think that question of how you can really price this is the core question. So by that kind of conventional risk bundle, okay, let's look at all these risks, see this offering as this kind of bundle of all the things that could go wrong, essentially. This is, I think, pointing to significant overvaluation in most cases. So where you have very little data, where you have an obviously very large risk space, even if you have this potentially enormous upside, you really have to discount that 95% more. And I don't think this is being done. So when you're saying, let's say a token is raising 200 million at ICO on the sort of high end, but this would be, let's say, a Series C conventional round. This would be an amount of funding that would be going to a pretty well-established company. And I think the main problem in this space is, with so little data, why is so much money being allocated really to so few firms? And essentially, yeah, that is I think the note I'd like to end on is where we have really very little to go on. We really need to take this into account in pricing and essentially see this as something which is highly, highly speculative, and we need to price based on this bundle of risks that is very, very expanded compared to the ones that we see with conventional startups. Okay, thanks so much.